Hello all, I'm Michael Watson, Head of Distribution. Thank you for joining our economic update. As we start a new financial year, it's timely to revisit our update from 12 months ago. And if a week is a long time in politics, it's an eternity in markets. Back in July 2021, pandemic risk remained centre stage, with much of the eastern seaboard of Australia in or closing in on a form of lockdown. Sydney was in lockdown from the 25th of June as the Bondi outbreak grew, with ongoing restrictions until Freedom Day, October 11. Victoria entered its fifth lockdown on July 15, ending on July 27, only to re-enter a sixth lockdown on the 5th of August, which lasted right through to October. All the headlines were about the slowness of the vaccine rollout, which may or may not have been a race. Just 11% of Australians had been fully vaxxed by July 2021. History tells us, though, that as vaccinations became more widely available, we willingly rolled up our sleeves. We now sit among the most highly vaccinated populations in the world. Economically, we were talking about the resilience of our economy. Despite headwinds, the economy was in remarkable shape. We had a government committed to expansionary settings, strong household balance sheets, unemployment at a 10-year low, and evidence that our key trading partners were, likewise, rebounding strongly. Oh, we were also talking about the ongoing surge in property prices, with double-digit growth in all capital cities. What a difference a year makes. Let's take a look at where a leading group of economists are predicting us to land. The headlines make for very different reading to those of July 2021. But has all the talk of doom and gloom overshot the runway? Looking at the views of the economists on screen, it has. GDP, predicted at holding a 4 handle in 2023, is now widely predicted to be from 1.8 or 2% right up to 3.5% from an optimistic Treasury Department. Still a long way from recessionary. Unemployment was strong a year ago and is even stronger now. While wage growth hasn't caught up to inflation, it is present, suggesting we might be within the definition of full employment. More on that in our headwinds and tailwinds section. House prices are forecasted to fall in the order of 15% peak to trough, a relatively soft landing considering that official cash rate is still expected to rise as high as 3% throughout 2023. This outcome, plus or minus a margin, would still not erase the gains of the post-COVID rebound in house prices. Overall, this does point to a positive result. Sure, there'll be challenges, but we have a starting point comprising economic growth, exceptionally low unemployment. It's a great position to meet the challenges ahead. On that note, let's look at some headwinds and tailwinds, which will help or hinder our progress in the year ahead. At a macro level, volatility in the global economy, fueled by the conflict in Ukraine, has had implications right around the world. Over 80% of advanced economies have had a downgrade revision to forecasted GDP. Worse for those who are net importers of commodities. Individual economies are all retracting from 2021 projections to more humble forecasts. While the drag on growth, none are anticipating negative annual GDP. Inflation remains a driver of the downgrade in growth expectations. In America, inflation recently reached the 40-year high of 9.1%. For context, in the decade leading up to the pandemic, US inflation operated within a tightly controlled band between 0 and 3%. A decade of cumulative QE, record low rates, low unemployment, high household savings, and of course the impact of the Ukraine conflict and supply chain constraints have all conspired to turbocharge this outcome. The monetary policy response to high inflation is quantitative tightening, most commonly seen through a hike in rates. A look at the last 7 decades of history shows that even following their back-to-back 75 basis point rate hikes, the US Federal Reserve effective rate is very low. History tells us that the Fed tends to go hard and fast when cutting or increasing rates, So the structural shift towards higher rates may be with us sooner than we'd thought. Looking specifically now at Russia and the impact of its debt and capacity to service. Russia has reduced its foreign debt over the last decade, but is now in technical default on a US $100 million bond. This far in, though, it makes little difference. Countries and creditors have written down their exposures to Russia, and there's little risk of global contagion. No one country has lent Russia a predominant share of its debt, either federally or to its people. In short, this means that short of inflationary pressures due to supply chain issues, the global economy isn't going to be hugely impacted by this default or the broader Russian debt position. A year ago, no one was really talking about inflation, but record low unemployment, a wave of people coming out of lockdown ostensibly cashed up, record low interest rates, and a decade of QE and all the various fiscal levers being pulled was a recipe for inflation. Add to that a conflict which led to an energy price shock, and that is where we find ourselves. With the headline CPI reaching 5.1% in March 2022, the effects of inflation are being felt across the economy on both discretionary and non-discretionary elements. With inflation of 5.1% outpacing wage growth of 2.4%, this has the ultimate impact of lowering the standard of living. We'll touch on the outcome of this on spending and confidence in a moment. Our own Reserve Bank was aware of the fragility of a rebounding economy, but like the US and other countries, inflationary outcomes drove the hand of our central bank, which has increased rates at its May, June and July meetings, and is widely anticipated to continue raising rates throughout this year and into the next. The normalization of interest rates was always anticipated to occur, however, in an orderly way, free from shock. Sudden hikes are, by their very design, immediate imposts onto the economy, aimed at reducing spending and reducing inflation. So we'll watch the second order impacts of business conditions, arrears, and confidence as the effects materialise across the economy. As powerful as inflation is, the expectation of inflation is likewise a powerful driver by itself. The RBA mentioned in its July minutes that medium-term inflation expectations remain well anchored. Just like the wealth effect, where the wealthier we are, the more we spend, is the reverse true. Right now, we are at an interesting juncture. Consumer confidence is low. Business confidence is retracing. The perception of whether now is a good time to buy a home is even worse than at the height of the 2020 lockdowns. It sounds grim and undoubtedly will weigh on growth, but the most interesting juxtaposition to these psychological measures is the stats. Retail trade figures sit at all-time highs, and forward-looking economic activity trackers likewise. We also discuss residential property sales in our property update, which remain above the 5-year average. Noting that the Reserve Bank lifts rates specifically to reduce inflationary drivers, such as elevated retail sales, it may be that it has some way to go before the neutral position of interest rates is reached. An ongoing headwind throughout COVID has been population growth and the impact on economic growth and the standards of living. Analysis we provided in April 2021 showed the impact of closed borders as being 402,000 fewer Australians in just 2 years, a genuine headwind for the economy, noting these include students and skilled workers. With the natural increase in population forecast to slowly decline in the coming decade, we need to see population growth resume for all the benefits, culturally, socially, and economically, that it brings. The inflationary impacts of low unemployment will otherwise continue and act as a huge impediment to growth. Right now, with net immigration to Australia effectively near zero, there is a lot of work still to do. Moving now to tailwinds, and let's consider one of the shining lights of all the economic outcomes through the pandemic. Australians overwhelmingly maintained their jobs. There was an initial spike in numbers which peaked at 7.4% in June 2020, which was well short of double-digit forecasts which were common at the outset of COVID. Unemployment has steadily decreased since the June 2020 unemployment print, and let's consider the amazing position we find ourselves in. Unemployment at 50-year lows of 3.5% in June, widely tipped to stay low and in fact go lower again. Underemployment of 56.1%, near historic lows. Participation rate at 66.8%, a decadal high. In short, at a macro sense, everyone who wants a job has a job. Of course, unemployment will never be zero, with people in the workforce between jobs or needing to reskill, but in essence, we will be pushing close to zero people out of work due to the economy itself. With that outcome, there are some obvious benefits. Wage growth is picking up. GDP returning to trend. Household balance sheets, which we'll turn to now, maintain the heft to withstand volatility in the periods ahead. The corollary of full employment of a population having been locked down is savings and wealth building. This, and a host of other drivers, sees household balance sheets in really strong shape. The obvious and well-documented outcome is the huge surge in household bank deposits, with Australian households still saving circa $10 billion each month. Our relative wealth to income is also at its highest levels, with growth in total wealth supported by financial assets, deposits, superannuation, other financial assets, and dwellings. Even removing some of the wealth due to increased prices of dwellings, and wealth is elevated. Importantly, the level of total household debt relative to income hasn't risen in concert with total wealth. The gap between total wealth and net total wealth has widened. Elevated cash holdings, deposits, and other financial assets and superannuations gives the Australian household tremendous ballast against potential volatility. The canary in the coal mine for inflation back in Q3 of the 2021 calendar year were the first order impacts of shipping rates, oil, materials like lumber, and food, to name a few. There is a body of evidence that these first order impacts are resolving, and while inflation is still high, the Reserve Bank's forecast of peak inflation in the December quarter might be about right. Shipping rates are falling nearly as quickly as they spiked. We note the International Freight Index showing the market rates are reverting towards the longer-term mean. Lower shipping costs, of course, leads to lower cost of supply. Brent crude, driving the cost of fuel like petrol or gasoline, is seemingly past peak and back trading at or under US $100 per barrel, against predictions of a slowing US economy. The cost of building materials such as lumber spiked twice, once as global economies rebounded post-COVID lockdowns, and again as the Ukraine conflict occurred. It's now back trading near longer-term averages. Commodity prices have so far remained high on aggregate. While prices are at the historic peak right now, individual sectors such as iron ore, copper, and other minerals see their futures all well down from peak. It would be a very bold analyst to call peak, but at least some of the key ingredients of the inflationary melange are normalising. As a starting point discussing the federal budget, Australia implemented one of the higher levels of discretionary fiscal responses to the pandemic, combining additional spending and foregone revenue of circa 20% of GDP. There are a range of tailwinds driving a remarkable return to lower deficits. We've already talked about commodity prices and the benefits they bring to our terms of trade, but we also have the tailwind of full employment driving tax income receipts. Full employment is an extraordinary thing. The difference in forecasted tax receipts from the 2022 budget to the recent 2023 budget is an improvement of circa $75 billion. The financial year 2023 outlook sees tax receipts returning to the pre-pandemic trajectory, compared to the previous two budgets, which forecast a downwards structural shift in tax receipts. While we might not dust off our back in black mugs for some time to come, the swiftness in the forecasted rebound is commendable. And that concludes our economic update for July. We hope you found these insights useful and welcome any queries on 1800 818 818. Thank you.